Have you ever wondered if you could take over someone else's mortgage because their rate is so low? This is known as a mortgage assumption. It's an appealing idea, especially with today's higher rates. But here's the catch. Most conventional loans aren't assumable, even though FHA and some other government-sponsored programs are. So what can you do instead? Stick around and I'll walk you through some smart strategies for buyers and sellers alike. But first, some background. Most conventional loans include something called a due on sale clause. This clause prevents the loan from being transferred to a new buyer, ensuring that when the property changes hands, the loan gets paid off. It is a way for lenders to protect themselves from rate fluctuations. This restriction affects you in different ways depending on whether you're buying a home or selling. First, let's review strategies for sellers. Home sellers often feel this is a major roadblock, but don't worry. There are still ways to make your property more attractive to buyers, even if your loan isn't assumable. One option is to offer closing cost credits to help buyers lower their interest rates. These funds can be used for discount points, which significantly reduce the monthly payments. For example, offering a large enough credit to reduce the buyer's monthly payment by $150 could be a major win-win. Work with your agent to estimate the right credit to offer for your home and market. Another strategy is seller financing. By offering a second mortgage with a below market interest rate, you can make the purchase more affordable for buyers. However, this comes with risks. If the original mortgage includes a due on sale clause, offering seller financing without proper documentation could trigger a foreclosure. To avoid this, it's critical to either pay off the existing loan or work with a legal expert to ensure everything is set up correctly. Now, strategies for the home buyer. If you're frustrated by the inability to assume a low-rate loan, there are still ways to navigate today's market. Start by negotiating seller concessions to reduce your upfront cost. These seller-paid closing costs can offset higher interest rates. Check out our video on seller concessions to learn more. Also, consider low down payment options like FHA, VA, or USDA loans. These programs make homeownership more accessible even when interest rates are higher. Working with a creative lender can also uncover financing solutions that you might not have thought about. No matter what strategies you as a buyer or seller use, collaboration between both parties is essential. For more information on buying or refinancing a home, visit mortgageresearch.com. If you found this video helpful, please like and subscribe for more tips and hit that notification bell so you never miss an update. And if you have any questions, drop them in the comments. We're here to help. Thanks for watching and good luck on your home buying journey.